So good evening or good afternoon or good morning to those of you joining us from Asia Pacific, and welcome to the GSA seminar or webinar. Sorry, so used to a seminar, but anyway, to the webinar. I'm Jody Shelton. I'm the CEO of the Global Semiconductor Alliance. So our goal for today's webinar is to have you hear from really one of the most revered analysts and bankers in our industry, Mark Edelstone, who is the chairman of the Global Semiconductor Investment Banking at Morgan Stanley. Again, probably most of you who are in this industry know him. And, Mark has been part of GSA since we started back in 1994. So we've seen a few things together. And Mark, hopefully this is the last crisis we're going to see together. So thank you for joining us, Mark. And thank you to all of the listeners. We're going to have time after Mark's presentation for Q&A. You can send in a question during his presentation, and we will collect those. And if you want to ask a live question, you can do a raise your hand at the end of Mark's presentation and make comments or ask questions. So with that, I'm going to turn it over to you, Mark. Thanks.
Wonderful. Thanks for that introduction, Jody. And unfortunately, it probably won't be our last crisis that we share together, but it's certainly one of the more interesting ones. And I have to say, it's probably the most dynamic that we're probably ever going to experience in our lifetimes. So I want to just thank everybody for joining. 5 o'clock on the West Coast on a Friday. Impressive that we have a very strong group of people that have joined here, and I'm sure, like me, you've all had very long weeks. So hopefully this will be impactful, and I'm going to spend the next probably 30, 35 minutes or so sharing with you broad thoughts about the economy and what we're seeing across the semiconductor landscape. I'll provide you some forecasts of how I think things play out here over the next couple of years, and then hopefully we'll have ample time for Q&A. So Julie, if we can maybe advance to the third slide, that would be great. Okay, so I want to just give you some initial perspective on just how much has changed in such a short period of time. We saw the S&P 500, actually all the broad market indices, peak on February 19th. The S&P 500 reached a bottom on March 23rd, so just a short month later. And during that month, we basically destroyed $10 trillion of value in the market, and we saw a 35% decline. Unprecedented. There is no period in U.S. history where we've seen that big of a decline in that short a period. The only thing that comes close to that was in 1929 when the market crashed, and we saw a pretty bad month there. But even still, this is a little bit worse than that. That was associated with a huge amount of volatility. That's what you see there on the VIX index, that 84.5%. Those are extraordinary numbers. That is an all-time high there as well. Now, unfortunately, this is all happening because the root cause of all this is the COVID-19 virus. And as mitigation efforts are going in place around the world, we're effectively having the economies run into a wall. And we probably could have done a much better job in parts of the world to control this so that the mitigants would not be so dramatic, but we are where we are, and the situation is incredibly dynamic. I can tell you that one of the nice things about being in a place like Morgan Stanley during this type of environment is that we have just unbelievable talent around the world in virtually every discipline that you could think about. So whether it be our biotech analysts, our tech colleagues around the world, our strategists, or our economists that can provide a perspective basically on every country and the global economy as a whole, everybody's been having to change their expectations here quite regularly. So our economists have had probably 3 major changes to their outlooks based on the new data that's coming in here. The most recent cut was yesterday, and we had big wholesale declines just a week earlier. So as of yesterday, we're expecting that in the second quarter, the U.S. economy will basically contract by 38% on an annualized basis. Again, these are pretty unprecedented numbers. This will be the weakest economy in the U.S. since 1946, and we're expecting that unemployment is going to reach about 16% in the second quarter. Now, for those that have been monitoring the short-term data, you know that we saw jobless claims in the last 2 weeks alone increased by 10 million people. These are extraordinary numbers, and so I think those numbers are going to remain very high here over the next month or so. The hope will be that we'll see the peak rates of decline in Q2 and then begin to see a recovery thereafter. But that's really the key that we need to see. And then last point on this page here is you see what's happened to interest rates, where if you wanted to give your money to the U.S. Treasury, which is the most conservative investment you could possibly make, it's backed by the full faith and credit of the U.S. government, that as of a week or so ago, that was yielding basically 0%. So you were basically giving your money to the government for free. That gives you a sense of just how dramatic the environment currently is. So if we can turn now to the next page, Julie, that would be great. So here we wanted to start with a framework because we know the root cause here. The root cause is obviously this virus that's led to a pandemic, and it's now causing all kinds of chaos around the world. And unfortunately, at the moment, the U.S. is really one of the bigger offenders. And not clear why, to me, people haven't taken this on as seriously as they should have, because we know how we can ultimately try to stop it. And the sooner we can stop it, the faster we're going to get our economy back in shape. There are other countries that did not do a particularly good job either initially, so Italy, Spain, France. We've all started to see those curves flatten a little bit, and so here it's really the second derivative of starting to see the rate of growth of cases slowing. In the U.S., we're still running at about 25% increases day on day, and those are very big numbers. There was a point in time going back probably a month or so ago where our biotech analyst was hoping that we could basically cause the U.S. to peak out in cases of around 200,000. As of earlier this week, he increased that to 570,000. We're currently, I think, at about 265,000 in the U.S. So at the rates that we're at now, where we're basically doubling in about 5 days, that is the fastest among anywhere in the world currently. You could certainly see a case where we're going to blow through his current forecasts. And that's really the big challenge, and that's what's obviously going to continue to impact our economy. Once we can get these things behind us, then we can kind of get the economy back in gear, and that's what we need to have happen. We do have a bear case, and the bear case would basically be that we are not able to get this under control until sometime in Q3. Our current base case assumes that we will see a peak somewhere in the second half of April, first half of May, and once we do that, and hopefully start to see the numbers get into a better state, get higher temperatures around the country and around the world, those things will all help to hopefully reduce some of the social distancing that's needed and get people back to work and get the economy rolling again. So let's turn to the next slide. And here I'll give you just a quick view of what's been happening with the economy. So in the upper left-hand chart here, this is our expectation of where the U.S. economy is going to be. And so we're in a recession now that started in the first quarter, where we believe U.S. GDP declined by 3.4%, and we're expecting to see it all out collapse in Q2, where on an annualized basis we'll see a 38% decline. That's the bad news. The good news is that we have seen more aggressive fiscal and monetary stimulus in the U.S. and around the world than ever before. And those are the things that are going to hopefully help get our economy back in gear once we put the clamp down on the virus and can basically get back to a more normal environment. To try to size that for you, as you all know, we saw in a week of basically the government trying to put out their fiscal stimulus, it was $2.2 trillion. That's about 10% of the U.S. economic GDP. So that basically buys us about 5 weeks, and they're trying to get that directly into small businesses and to workers that will hopefully be able to maintain a reasonable standard of living. As we know, the U.S. economy is dominated by consumers. It's about 70% of our economy, and so we need to obviously have consumption to be able to get back on track here going forward. Now you can see in Q3 and Q4, it's a very sharp snapback. But the current expectation is that because we've let this virus impact us as much as we have already, we're not expecting to get back to pre-COVID COVID GDP levels in the U.S. until the fourth quarter of next year. And that's going to be really important to think about relative to how we think the semiconductor industry will do over the next couple of years as well. And I'll have more detailed thoughts on that as we move forward. You can see on the upper right the unemployment spike. Again, these are pretty unprecedented types of numbers. And that's all coming from a lot of the airlines, hotels, hospitality, restaurants, retail. All those things are obviously very challenging, and I'll talk about how the world might change here forever based on what we're going through right now. The lower left here is what's happening in global GDP, and so the world is in a really difficult place as well. We're now expecting that we're going to see a contraction in the global economy of 2.1% in 2020. That's our base case. Our bear case would be twice as deep, so 4% decline. Now, to put that in perspective, global GDP contracted by 0.5% in 2009, and that was a pretty bad time. Again, you can see the snapback that we're expecting, and I think if there are some silver linings here, if you look at the bottom right chart, that shows you the PMI index for China as well as for other regions outside of China, the larger regions, Europe and U.S. and other major countries. And below 50 would basically be economic contraction, and above 50 is growth. You can see that massive spike that happened there where we were above 50 in China, and then it fell apart over 2 months, and it's now recovered here pretty sharply. So what's really interesting about this environment, and again, it's largely because we've created the issues for ourselves in terms of not getting in front of it as quickly as one might have liked to have seen. And so we've got different regions around the world that are reacting here differently. So China obviously is where it started. They managed to constrain their exposure, and hopefully the numbers that we're seeing there are all accurate. Regardless, it seems like they've done a pretty good job of mitigating this and effectively nipping this in the bud relatively quickly. So within about 70 days after they saw their peak number of cases, their production rates in their economy got back to about 75% of normal. They're now about 85% of normal, and that's what you see here on the PMI index. So the hope would be that we can use that and look at every other country around the world and see the same type of snapback. Certainly we'd see similar numbers, I think, in Korea, in Taiwan, and then the hope will be that when we look at places like the U.S. and Europe, that we'll see similar types of trends. That's on the production side. Obviously, the consumption side is lagging in China and elsewhere as well, as everybody wants to make sure that they can stay healthy. And so that's going to be one of the lag effects here, I think, that we're going to see in the recovery, is just how quickly will consumers get back to a normal environment. And normal means that we're all willing to get on planes, stay in hotels, go to sporting events, concerts, eat out in restaurants, and so on and so forth, that everybody on this call does all the time. So turning to the next slide. So let's talk about what we've seen in the broad stock markets. And for a lot of the deck, what I'm going to share with you here is comparing this crisis and downturn with that of the tech bubble in 2000, that I'm sure many of us remember quite well, and then what we saw in the financial crisis in the 2008 timeframe. And this is just plotting the S&P 500. Everything is basically normalized to 100, and you can basically see what happened. The tech bubble bursting was just a very long, drawn-out affair. It took us a very long time to sort of work through that. The financial crisis, you can see, was much sharper to the downside, just took place a lot faster, and this is basically peak to trough. And you can see here now what we've seen in the COVID crisis, that it's been very sharp, much sharper than anything we've seen before, as I mentioned. And the question is, what will basically happen from here? And I'll provide some insights as we move through the rest of the presentation. So turning to the next slide, this gives you a sense as to how we might just think stocks will perform. And on the left-hand side of the page here, you've got the S&P 500 and its PE multiple. So this is basically the multiple that the S&P trades at over the next 12 months. You can see it's just under 18 times earnings. That's a pretty reasonable valuation today. And I would say, given where interest rates are, that's a pretty fair multiple to have. On the right-hand side of the page are historical earnings per share for the S&P 500, and that's how you basically get your multiple. You take the price of the S&P, divide that by your EPS, and you effectively get your PE multiple for the S&P. On the right-hand side, the far right-hand side of that page, the right-hand side of the dotted line, that shows you what's been happening to estimates for 2020 and 2021. And so the first two bars there, the white bar and the light blue bar, those were what were consensus forecasts going back over the past, let's say, 2 months or so. The dark blue line, that is what our market strategist views as earnings for the S&P. And you can see down pretty sharply, down sort of high teens in terms of earnings decline in 2020, and then up low double digits in 2021. A couple of takeaways here. One would be that if you look at where we're going to see the expectations for earnings in 2021, there's effectively been no growth from 2018 until then. And so that's a big challenge here, and effectively what we've seen here with COVID, it's just wiped out effectively a significant amount of what would have been potential growth in earnings, and that comes after 2019, where you saw very little earnings growth. So that's point number one. And then when you take that in conjunction with where the multiple is on the S&P, it says there's probably not a whole lot of upside for stock prices here in the near term. And quite frankly, I think what has to happen here over the next 3 to 6 months is we need to see the fundamentals catch up to where the stock prices are. The stock prices reacted very sharply to the downside, as you'd expect, given this massive change in the economy. And I think you're going to see stocks kind of trade broadly sideways with a downward bias as we see the earnings expectations decline, and then hopefully find what will be a solid level that we can grow from again in the future. So turning now to the next slide, I'm going to start drilling into what it means for individual companies in the tech sector. And this is a pretty interesting slide. What you have here would be the top 20 technology companies in the world, and we've kind of color-coded them based on semiconductors, if they're in enterprise or if they're in consumer. And the y-axis here shows you what the change in earnings estimates have been for 2021, basically since the market peaked on February 19th, and then the x-axis is the change in PE multiples. And basically, if you just ran the algorithm off of those two variables, the output for that would be the change in stock price. So a couple things I would point out. One is that over the next few weeks, as every company reports their first quarter results, I think you're going to see a general trend for earnings to come down. And so just the split between how much has been decline in earnings expectations and how much has been decline in PE multiple will change. But for now, at least there's some learnings here I think you can take away. And so if you look at the companies that have done the best here, so they're flat to, let's say, down 10%, and that's quite good in this environment. Netflix, Tencent, Amazon. These are the new economy. These are companies that are basically benefiting from cloud, data center, the ability to basically do e-commerce, and that all makes perfect sense because we're effectively changing consumer behavior here pretty dramatically. If you look at the companies that have done the worst, it's been companies either with too much leverage or companies that are going to be tied to markets that are going to be under pressure. Sticking with sort of the overall software ecosystem theme, when you look at something like Facebook or Alphabet, I think they've been under pressure because advertising dollars have been cut, and a lot of their platform is tied to the success of that. Something like Qualcomm, I think, has been hurt here because belief is that we're probably going to see lower consumer demand. That probably doesn't bode well for at least 5G handsets and so on and so forth. So you can really start to see the winners and losers that shake out in this very dynamic environment. So turning to the next page now, I'm going to really drill into the semiconductor industry, and the intent here is to really help you think about what happened in prior cycles. The two I named were the tech bubble of 2000 and the financial crisis of 2008, to really be able to learn from those. And every cycle is a little bit different, so there's going to be nuances, but at least I think you get a pretty good sense of what we can take away from those and how we might apply them to today. So let me just first call your attention to the top row. This shows you what was happening with global GDP as we went into those downturns. And you'll notice that in both 2000 and 2007, the economies were very, very strong. We ran on either side of 5% growth, and that's really high. Over the last 60 years, global GDP has only averaged 3.5%, and so we effectively built excesses coming into those downturns, and it took a bit of time to sort of wash them through. In the tech bubble, that was really a tech phenomenon. It obviously spilled over into the broader economy, but you'll all remember this was just way too much funding going into tech, way too many companies doing less competitive things than they need to, valuations that were outrageous, and that ultimately led to just this big unwinding and wringing out those excesses, which took years to happen. The financial crisis was really tied to bad loans, bad credit, and just too much leverage, and the banking community being over-levered, which compounded those problems. And so again, it impacted the broad economy more significantly than the tech bubble, but it was sharp, and we kind of got through it in relatively short fashion. I'll show you some other charts that'll help prove that point out. In the case of this crisis, we came in with global GDP at 3.1%. That's actually below the average, and you can see we are now going to, down a couple percent and then snapping back very, very sharply in 2021. I think the difference of now versus, say, the financial crisis is that in the financial crisis, the issues were festering for quite some time, and it took many months before you actually saw big fiscal stimulus and the Fed really act and provide very accommodative monetary policy. As we all know, in this current environment, it happened immediately. The Fed basically did two big cuts. They took interest rates to zero within a couple of weeks of starting to see signs that this would escalate. They're out there buying treasuries, they're buying commercial paper, they're buying corporate bonds. Those things are providing liquidity to the markets. And then, as we saw, the U.S. government, which never does anything particularly quickly, within a week was able to get this $2.2 trillion fiscal stimulus package going. And so the hope is that all the money that's being spent here is going to go to the right places and allow the healing to basically, play out here as the economy bottoms out in Q2 and then ultimately, hopefully, recovers from there. So let's talk about what happened with semiconductor stocks versus the market. You can see on that second row the S&P 500 and just how sharp the declines were. Interesting to note that the semiconductor stocks basically were underperforming by 50% versus the S&P 500 in the tech bubble. And that makes sense because, again, this was really just excess valuations and a lot of just general overbuilding in the tech sector that we needed to basically wring out over time. If you look at how the semiconductor stocks acted in the financial crisis, they actually outperformed the market. And again, I think that's because, a dozen years after the tech bubble, the semiconductor industry was a little bit more consolidated, probably better managed, better cash flows, and the market was willing to recognize that. In the current time frame, you can see that the semiconductor stocks are basically trading right in line with the market, although I would point out that on up days, semiconductor stocks are generally outperforming, and we'd expect that to be the case here going forward. So in general, I think our industry is better positioned than the broad companies of the S&P 500, and therefore we'd expect semiconductors to basically trade a little bit better, and ultimately when this is behind us, I think they will outperform pretty meaningfully. So let's talk now about fundamentals, and here you can see that in both those last two downturns, semiconductor industry revenues were down more than 30% peak to trough. Our expectation is that we'll see the peak to trough declines here be down 10 to 20%, and the peak of this cycle is effectively going to be November of 2019. And so from that peak to what we think will be a trough by the end of next year, we think we'll be down 10 to 20%, and right now I think we're going to be towards the lower end of that, and there's certainly risk it could be a little bit worse than that if we cannot get the COVID caseloads to continue to slow down fairly quickly. So I think if you start to see that there's not a peak in the number of cases, let's say by the middle to latter part of May, that I think it's likely to assume that the semi industry will decline by more than 20% over the next 2 years. You can see the semiconductor capital equipment companies there. It's quite a bit worse historically. In those last 2 downturns, while the semi industry was declining by more than 30%, they were declining by 70%-ish, so about 2x the impact. It's probably likely you'll see something similar this time around, where whatever the decline in semis is, it'll be up to 2x worse for the capital equipment companies. And then just lastly, to give you a sense of what happened in credit metrics, you can see here these are spreads on BBB, so investment grade bonds and high yield bonds. And you can see they look a lot more like what we saw at the tech bubble than the financial crisis. And again, that all makes perfect sense based on the fact that this is really not about the financial sector. This is just a very different type of decline. Okay, let's turn to the next page then, and we'll drill down even further into the semiconductor industry. So one of the reasons why we think that the decline in semis is going to be less bad than it will be for the overall economy is that there are portions of our industry that are going to benefit from what's going on. Now, it's all going to be relative for sure, but what we've highlighted here would be the sectors that we'd expect to be stronger versus weaker. And then on the x-axis, we're showing a percentage of revenues as a percentage of total semiconductor revenues for those sectors. And so I'll just take the bookends to start. So the areas that will be the strongest will be companies that are playing in cloud, data center, and communications infrastructure. We'll also see gaming as people are spending more time at home and so on. And at least in the initial days here, we've seen a spike in PC demand and other sort of home networking things as the work from home phenomenon really takes over in a way that's been unprecedented. On the other end of the scale, you've got automotive, which we think will be the single weakest sector. It's our view that we're going to probably see a decline in car purchases this year to be more than 25%. Those are really dramatic changes. And we're going to have most of the auto factories here in the U.S. and Europe shuttered for the next 3 months or so would be our sort of minimum guess. Consumer is going to be difficult as well. Cell phones, you have to expect that things are going to be weaker there, and unfortunately, that is the biggest consumer of silicon at about 25% of the industry. So when you kind of net it all out, you can see here we boxed it as 37% relatively stronger, 63% relatively weaker. I think if you drilled into that even further, you'd probably find that it's probably more like a quarter that's somewhat better and 3/4 that is, materially worse. So the future drivers here, clearly cloud, 5G infrastructure. We all need a lot more bandwidth to deal with what we're dealing with. There's going to be a lot more telecommuting in the future, and I think that, quite frankly, what we've seen here in the world is going to hang around with us for quite some time. I think there's been a trend for a long time now where the old type of way we did business, getting on a plane at a moment's notice, going to stores rather than doing things online, we believed in our space for a long time that tech will impact the entire global economy, and we're still in the early days of that. We all have lived tech for decades, but in terms of tech really impacting everything around us, that's still very much in process, and I think what we're going through now will just accelerate that over time. So turning to the next slide, here is a look at what happened over the last 20 years where we can measure the last 2 down cycles. Those are the shaded areas of these 4 charts. And the upper left is total semiconductor and semiconductor capital equipment revenues. So that is the entire industry. And the real takeaway here is that in the financial crisis, it took us basically 11 quarters to go from what were peak revenues to new all-time revenues. That was roughly half the time of what it took during the tech bubble. So in the tech bubble, it took us 21 quarters to get back to new record revenues. So 21 down to 11 quarters. And I already gave you an expectation that I think we'll do it here in probably something like 6 to 8 quarters, assuming that we can again get a peak in the coronavirus over the next, let's say, 45 days or so. If we don't do that, then it's going to take a little bit longer, but I still think it's going to happen within the 11 quarters it took during the financial crisis. If you look at the bottom half of the page, here we're looking at what happened to gross margins and EBITDA margins. And the kind of two takeaways here is, one, you got back to record margins in the financial crisis significantly faster than you did in the tech bubble. And then the sheer amount of the margin compression here was a lot less. And I think based on how the semiconductor industry today is structured, where you've got more variable cost businesses, companies are better run, you've got fewer competitors given what happened with the consolidation in the past half a dozen years. Just in general, I think you're going to see the fundamentals come back that much faster, and the margin compression will be less. Turning to the next page, this then shows you what's happened with our valuations over time, both on an EBITDA multiple and a PE multiple. And there's no doubt we're going to see earnings come under pressure here. As I mentioned, a 10 to 20% decline in your revenues. For the most variable cost business models in our sector, so I'll just focus on semiconductor companies, so people like Xilinx, which are fabless and have phenomenal pricing power, or Maxim, which is fab light, or Silicon Laboratories, these kinds of companies, typically when you get a big decline in revenues, like 10 to 20%, you're going to probably see about a 2x multiple on earnings. So if revenues were down 15, you'd expect to see your earnings probably down 30. For companies that are more fixed cost, like a Micron, Intel, Applied Materials, there you'd expect it to be probably 3 to 4x your revenue decline. The key thing I want to point out in this chart is if you look at the PE multiples at the bottom, you can see there that you've got multiples that are in the upper teens. If we were to see a 20 to 40% decline in earnings estimates from here, and recognize that most analysts have not really cut their estimates across the board, so we're clearly going to see more earnings cuts going forward. If we saw a 20 to 40% decline in earnings estimates, then PE multiples are really between 23 and 31 right now, and that's well above the averages over the last 1, 3, 5, and 10 years, which were closer to 20. So it's another reason why I generally believe that while we've already done a lot of discounting of the bad news of stocks, it's likely that we're going to see stocks best case sort of trade sideways here as we kind of work through this issue of seeing the fundamentals catch up to where the stocks are, if you will. So I think we probably get a very broad trading range, because if stocks were to go up a lot from here, they're going to look really expensive. And again, hopefully we've already cushioned a lot of the downside. And you sort of see that as well. For those that watch the markets as closely as I do, between yesterday and today, the market is up slightly. So we were up yesterday and down today. You net them out, we're up slightly, and that compares to Wednesday's close. Now, the jobless claims that we got yesterday were far higher than anybody would have expected, and that has triggered our economists and other economists to basically think that this downtick in Q2 and the recovery in the second half of the year are going to be more challenged than they thought just a few days ago, and yet the market net is slightly up. So I think that just tells you a lot of bad news has been discounted. The problem is we really need to kind of get through the next 3 to 6 months and probably be in this broad trading range to have everything kind of work through the way it needs to. So turning to the next page, this is looking at a portfolio of semiconductor and capital equipment stocks that we put together that represent about 2/3 of the total revenues of both industries. And it shows you over time how these have basically performed. And I think you get a very good sense here when you look at the data as to the complexion of what those prior crises looked like. And so we're asking ourselves, will we have a V, U, or L-shaped recovery here due to the COVID crisis? If you look at what happened in the tech bubble, it's clearly an L-shaped recovery, and that makes perfect sense. We went down a lot, but we really just went sideways for a long time. It was very choppy, and I distinctly remember thinking that, hey, things are getting better, and all of a sudden you had another downturn as we just took a very long time to sort of work through these excesses. So to think about it a different way, to go from what were peak stock prices in semis to a new all-time high, it took us 2,100 days, so very, very long duration. That's an L-shaped recovery. If you look at the financial crisis, it looks more like a U, and you can see we were down a little bit harder and faster than we were in the tech bubble. But when we recovered at almost the same rate that we went down. And so it took 420 days to go from peak to trough, and then it took another 450 days to go from trough to peak. And so all in, we basically did it in about half the time that we did of the tech bubble. So classic U-shaped recovery. Now, what we're going through today, you can see the purple line, very sharp decline. Again, my expectation is we need to kind of bounce along the bottom here for the next 3 to 6 months, and then hopefully we'll get a little bit more of a sustained recovery. The things that will really set us back is if we get into the summer months and it feels like COVID's under control, and then we get a relapse around the world, that's where it's really going to be concerning, because I think the most optimistic things we've seen is that you could have a mass-produced vaccine available sometime in the spring of 2021. So that's a year away from now. And until we have that, it's going to be very hard for everything to get back to perfect normalcy. Current expectation is that if I'm right, that we're going to see record revenues in our industry by the end or towards the end of next year. You should see stocks at record levels by the middle of next year. So I think watch this space and pay very close attention to how quickly we get this virus under control in the next 45 days. Turning to the next slide, here we're going to drill down into some of the individual stocks in our sector. And this is a broad subset of companies, and it looks very similar to the chart I showed you earlier with the top 20 technology companies, but here it's just into the semiconductor stocks, and showing you the same type of mix, if you will, between how much earnings have gone down versus how much multiples have gone down. I think you're going to see a lot of these stocks sort of shift down on the page over the next few weeks as everybody reports their quarters, and as you begin to see estimates reflect lower numbers for 2021. But if you just look at how stocks have performed so far, the stocks that have been the weakest are those that have the most leverage or are tied to the most challenging end markets like automotive. So Renesas, which is the worst performer on the page, has really suffered from both, a lot of leverage and tied into the automotive sector. You can see also companies with a lot of leverage like WD or Microchip have also been adversely impacted. If you look at the other side, you can see companies like Marvell or Inphi have actually done much better. They're down, but they're down 10% or less, and that's really because they're tied to the right end markets. And here it's really about cloud, data center, infrastructure. And then you see everything else by and large sort of in between. Let's turn now to the next page, and here I'll give you a quick view of what we've been seeing companies publicly say. And so in the lower left-hand side of this chart, you've seen pre-announcements from a dozen companies, and they're all pretty broad. We might get a handful of more companies to pre-announce next week as they've seen their numbers now the quarter is closing. But in general, we'd expect to see a downward trend to earnings in Q1 and pretty broad and somewhat weak guidance in Q2. Because of lagged effects of our industry versus the broader economy, I think it's very likely that we'll see the fundamentals of the semi industry be much worse in Q3 than they are in Q2. So while I said earlier that when you look at U.S. or global GDP, the bottom appears to be Q2, and then you're recovering in Q3 and recovering more in Q4. I think in our industry, Q2 is going to look a lot better than the overall economy. Q3 is probably our biggest weak quarter because of just the breadth and depth of the supply chain. I think in the near term, you've been seeing companies basically want to build inventory within the channels and in their own balance sheets. This is the customers. That will probably change as we get into the second half of the year, and Q3 will probably be a bit more problematic. On the upper left, you can see companies that basically have withdrawn guidance either for the quarter or for the year. And then on the right-hand side of the page, you see companies that have basically been looking to try to shore up liquidity. So you've seen 5 companies here that have basically drawn down their revolvers to make sure they've got ample liquidity. And you've seen Intel and NVIDIA basically look to issue debt opportunistically to build cash on their balance sheets. So turning now to a little bit of what we think about as scenario analysis, and this is in the Clint Eastwood parlance here. So you've got good, bad, and ugly. and we'd associate that with V, U, or L-shaped recoveries. If we looked at trying to handicap this from a probability perspective, I think what I would have told you just a handful of days ago is that good and ugly had 10% probabilities of each playing out, and that 80% was in bad. As I continue to see these escalations in momentum of the virus, and as we know, there's parts of our country here, especially in the center of the country, that are just not doing a particularly good job of sheltering in place and maintaining social distancing. And so that caused me concern that the probability towards ugly is increasing. And so if I were to kind of mark this to market now, I'd probably say it's 10% good, 70% bad, and 20% ugly in terms of how this basically plays out. So if we just kind of focus most of our attention on the bad piece of it, it clearly tells you we're in a bit of a weak demand period. It's going to take time for things to improve. Our single, if we really tighten the range, we think it's probably down 10 to 20, but you can see it could be closer to 30 if things don't get controlled here as quickly as we'd hope over the next 45 days. And then really what companies need to be doing here is to make sure that they have proper liquidity. So really think about, do they go to market? The investment grade market is open today. The convertible bond market is open. You've got private equity that's willing to basically invest in companies. And so there are places where people can go get capital today if they need it. And then I think it's going to be a very interesting environment for M&A. And I think the strong companies that really do the right things, cut discretionary spending, but don't really do any more than that, and really make sure that they stay fundamentally strong in their core businesses and strategies, those companies are going to come out of this much stronger than where they went in, and they'll have a competitive advantage over players that they compete against that are not in as strong of a position. And so we'd expect that you'll see some M&A happen here. It's going to be very hard to do cash deals because everybody's stock is depressed, but for companies where they both decline by equal rates, those are the kinds of companies where you can go do stock deals, and we think that will happen. In prior crises, we've seen stock deals basically take place, especially as you get closer to the end of it, and we think that'll probably be the case here as well. So turning to the next page, and this is really how I want to end the prepared comments, and I'll open up to questions, but I know there's a lot of challenging messages here to think through. This is a resilient world that we live in. We have resilient economies, a lot of smart people. Just like other crises we've seen in the past, this really will pass. And we think this near-term environment, while being challenging, there are a lot of opportunities ahead. We've got great secular demand drivers in our industry. This industry is better managed than ever before. I think the value that we generate and create in our industry and the fact that investors kind of recognize that is better than ever before. So we're in a really, really good position for companies to do the right things, and when the recovery comes, it'll be pretty robust. And again, unlike prior crises, this one has a very easy to find root cause, and I think it's pretty easy to basically figure out how to mitigate it and to basically move forward once we've hit the bottom. So with that, let me open it up to questions.
All right, thanks so much, Mark. I appreciate your insights and your presentation. We'll go ahead and open it up for questions, and please use the Q&A feature if you'd like to submit a question or raise your hand, and we'll allow you to talk live and verbally ask your question. But we'll go ahead and start with the first one. Mark, will the automotive shutdown impact the transition to EV and self-driving cars?
Great question. So, and we've been thinking a lot about this. So I think the move to EV, no, I think in general that is still going to happen. And no doubt we're going to have some churn here in the industry as we have to kind of work through things. And what I find to be quite fascinating is that, and maybe it's just because the supply chain is so complex in the OEMs dealing with tier ones and tier twos and threes and so on, that I don't think we've really seen the full magnitude yet of what we will expect. So I think bookings for our companies have really not changed much. I suspect that as we go through Q2, we'll see a very sharp fall off in demand for semiconductors coming out of automotive. But from a secular point of view, I think the EV side is going to to do fine. Maybe it pushes out by a little bit, but that is a secular trend that is going to remain very much in force. On autonomous vehicles, I think we've already seen, even before we got into this crisis, that there's been a push out there, and I would expect that to be the one area where the ultimate move to autonomous will take longer because of the environment we're in today.
Great, thank you. Next question is, do you see any delay in 5G deployments due to COVID-19? I know you mentioned Qualcomm a bit with 5G situation. If you maybe could expound a little bit on that.
Yes, so I think infrastructure is going to be fine, and if anything, infrastructure really will probably accelerate. I think on the handset side, I would expect, since that is really a consumer discretionary item, I would expect that will be slower. And I'm sure you've all seen indications that the 5G launch that Apple had planned will either get pushed out or maybe will be somewhat slower than we would have expected before. That all seems right to me. There's no doubt that what we're going through here, despite all the fiscal and monetary stimulus, when you see unemployment like we're going to go to at 16%, we're talking over 20 million people out of work in the U.S. At the margin, that is actually more than at the margin. That is clearly going to hurt consumer spending. And one of the things that one can easily do is just push out the time to swap out their phone for a new one. So I think 5G will be slower. My guess is that maybe the real sort of knee of the curve, where it might have been sort of later this year into next, it probably pushes out into maybe the second half of 21 and beyond.
Great. There's kind of a two-part question here I'd like to try to structure. One is, how will COVID speed up or slow down M&A activity? And also, who do you see as potential M&A targets? I'm not sure if you can answer that completely, but.
Sure. So I will definitely say, I think that when you get into this type of turmoil and this type of volatility, it definitionally will slow M&A. And it will also clearly have a negative impact on cash-related deals. You can definitely still have stock deals that happen. So it's where company A basically is using their stock to get company B's stock. Those type of deals will happen, but generally speaking, we will see a slower M&A environment until we get into more of a recovery mode. And then in terms of targets, I'm obviously not going to be able to share individual names here, but what I will tell you in general is that we think that there's going to be a lot more consolidation in semiconductors. And if you go back to 2013, and we use that time frame because that was the period when you saw Avago buy LSI Logic, and then Avago went on to buy Broadcom, and now it's called Broadcom. That really triggered a massive change in the M&A environment in our industry. And so we had about 110 pure play public semiconductor companies at that point in time, and we now have more like 70. And it's continued to be our belief that over the next 5 years or so, we're likely to cut that number in half again and get down to a few dozen very large semiconductor companies. This is an industry that really requires scale, and so that's why you're seeing the M&A that we've seen. And the companies that I think are the biggest targets are those that are not doing much M&A. So M&A is hard, as I think all of you know, and companies have the DNA to do that, and the ones that do, I think, will continue to participate. The ones that don't, I think, will end up being the acquisition targets, because in a world that is consolidating dramatically around you, if you're not a buyer, you're kind of standing still, or actually you're really kind of falling behind, and I think you become a more likely target. And just good examples of this would be companies like Linear Tech and Altera, fabulous companies that really didn't have the DNA to do any kind of meaningful M&A, and they ultimately became very good targets. So that might be a little bit just a roadmap to think about. Next question, please.
Great, thank you. How will a prolonged U.S. economic recovery affect China's economic recovery?
So it's interesting. That's a great question. So, we know by the data that I talked about, and I showed you, like the PMI in China, that China is back to a fairly normal environment now from a production point of view. but we need the consumption side of things in China and around the world to improve. And so that's going to lag, like you've probably seen, like I have, things like movie theaters in China where, those they opened and they've closed them again. And so we really are going to need to see the consumption around the world improve. And the U.S. economy is the biggest in the world, followed by China. And if we see a weaker recovery that just takes longer to get back to where we need to be in the U.S., and I've already highlighted the fact that our current economic forecast is that we don't get back to pre-COVID GDP levels until the end of 2021. If that continues to push out, then that's definitely going to impact everybody around the world that supplies into that demand, if you will.
All right, next question. How do you define the L-shaped recovery or the bad case in terms of global GDP growth, and how can we track that?
Yeah, that's a great question. And so, first off, as I mentioned, we're going to see GDP down about 2% globally this year. If we go into the, much more of an L-shaped case, and I think you'll start to see signs that if we just either cannot get COVID under control here in the U.S. and in other of the hot spots around the world, like Spain, Italy, France, and so on, if we can't have that happen by the end of May, then I think we're probably going to see our economists cut their forecast again to their bear case, which would be down 4% this year. Now, at some point, once we put this behind us, we're going to get a pretty sharp snapback. But I would just really, I think the things to track, and the good news is the data is very, very available. You can just look at what the CDC is providing and just look at what's happening with the rate of growth of the virus in every region. And if that just continues to escalate and we don't really curtail it, I think you're going to move into more of that L-shaped type of environment. And then the other thing to be very, very cautious about is what does the second wave look like? So again, I think the expectations are that we see the peak here sometime in the second half of April into the first half of May. And the weather in the U.S. and other parts of the world will help us, as the belief is that as heat indexes go up, that will slow the spread. As we get back into the fall and winter time, if this thing comes back in an aggressive way, that is clearly going to shock the economy again and be problematic. Remember, there's a lot of, the good news, I think, there's a lot of technology and knowledge being thrown at this to try to basically create the vaccines against it. And I'm actually pretty hopeful that that will happen in the not too distant future. Then you got to get through clinical trials. And so from what we've seen, it seems like the fastest that we could really get a mass immunization, similar to what we experience now with just the influenza, where we all get our flu shots every year. It seems like the fastest that can happen really is next spring. And I think the real challenge between then and now is, can we sort of keep this all under control? And if we can't, that's clearly where the L-shaped or worse comes into play.
I think we have time for one more question, Mark, if that's okay with you. Understanding that Intel and NVIDIA issued debt, over the next 3 months, do you expect it to get easier or harder for strong companies to raise cash?
Okay, that's a great question. So both Intel and NVIDIA are investment-grade companies, and the investment-grade bond market is actually quite open. For those of you that are in the treasury or in the finance part of your businesses, you probably know that the cost of that capital is more expensive than it would normally be. But nevertheless, that market is wide open. And I think the good news of the fact we've had so much monetary stimulus go into the economy here by the Fed, and the Fed seems like they will do whatever they need to make sure that we're going to have liquidity in things like the bond market. I think companies will still be able to actually raise capital, and I suspect that as we get into the summer months and hopefully we have a lot of the escalation of the virus behind us and start to see the economy getting at least somewhat better, I suspect that the investment-grade bond market will be more available, and you'll start to see the high yield markets come back as well. So I suspect that the markets will open up 3 months from now more than they are today. And I think the other just challenge to think about here for those, again, on the finance side, that what we're doing here in terms of all the stimulus is going to lead to much bigger deficits as a percentage of GDP. And ultimately, you would think that would be inflationary. And so that starts to change what we've experienced here for the last really 40 years, where we've had a very deflationary economy around the world. There's probably some pretty good inflationary currents that we have to focus on here in the future. So with that, again, I really appreciate the questions. I appreciate everybody being with us here. Again, I am quite confident that we will ultimately get to the end of this crisis, and I think our industry will shine as we come through it. I think the adoption of technology, especially as it is shifting to the cloud and much more e-commerce and everybody doing a lot more things with tech than we had done before, is going to be a very positive trend for our industry. So with that, I thank you very much. If people do have other questions, you can certainly feel free to send me an email, and these slides are available. I think if you just let Jody and Wade and the GSA know, they'd be more than happy to send them out to you.
Okay, thank you so much, Mark. That was so informative. We really appreciate you doing it. And we have a couple more webinars coming up. So we have one on Monday with Handel Jones, and then on the 8th, which I think is Wednesday, we have one with Dan Niles. So be sure and tune in, and we'll get, every day is a new day, so there's always new information. So we appreciate you guys being part of this, and good luck, stay safe, be healthy, and we'll see you soon.